past 10.
Yeah,
So
I think we can continue.
Yeah. Still people joining. So
Well.
a bit distracting sometimes because I have to click on it at the same time, or maybe Gino, you can also click.
Yeah, I will click for the if people will join. No problem.
Okay, good. Great. Just to recap a bit from earlier, also for the people that joined at a later stage, feel free to ask questions in the meeting chat, or to raise your hand and ask the question in real, in real life, but still online. So that's just to make sure that if things go too fast, or if you think, can you elaborate on this topic a bit more, then we are happy to do so, because I think we will have plenty of time also for the introduction to the business case for the group assignment, which will start now with this beautiful picture, which is also related to the group assignment. So the introduction to the business case, we are now going to a real life case that was financed somewhere over the last years, and it has been tweaked somewhat, of course, because we cannot share all the real names and figures, as you will understand. But just so you know, this is not some textbook example. It's a real life case with a real life photo of the realization of the project in the end. So the business case, we have the Dutch solar power company, the SPC, which is a long-lasting client of the bank, and they want to build and exploit a 17 megawatt peak floating solar installation in the municipality of Almere, the Netherlands. And that is what we call the project that we look at. The SPC approached the bank for a financing proposal. Gino talked you through the important items of looking at a project, and here we know that the PSC, the SPC, well, any case, the SPC, I think, is an experienced company, and they already realized over 500 megawatt peak ground-mounted and rooftop solar projects in the Netherlands. But they are now looking into their first floating solar system, which is a different technology. Of course, the solar part is the same technology, but it still has to float as well, and it still has to float after 15 years because otherwise it will not very much be bankable. So to pick up on extra knowledge on the floating part, they started a 50-50 joint venture with Floating Solar Tracking Corporation, FSTC. And FSTC, which is founded in 2020, is a construction company specialized in floating solar systems, and has already built 2 systems with a total installed capacity of 25 megawatt peak. And these installations were built for a water purification company and didn't require any bank financing. And that was, also relates to what Gino said earlier. You want, when giving bank financing, it is important that you have confidence in that the project will really come into existence and will be there for the full lifetime. And here they start with a project that didn't require any banking financing, and then they can gain experience in building these systems. The installations consist of 14 different floating solar tracking systems, and each system is a round-shaped island with a size of 1 hectare and a diameter of approximately 100 meters. And with this type of installation, vertical axis tracking can be realized, and that means that you have the inclination, the angle of the panels fixed, but the field rotates to gain maximum solar radiation. And that means that you can have extra extra capacity compared to a static system. And this is presented on the photo. You can see that it can turn around. The total cost of this investment are estimated at around 10 million, and that consists of turnkey construction costs, the grid connection, and to have the connection to the grid, to give your power to the grid, due diligence costs, legal, technical, etc., the development fee for the company that develops the project, bank costs, and the contingency costs that we also talked about. If the bank decides to provide the loan, this will be the first solar project in Europe to obtain bank financing. As joint venture partners, DSPC and FSTC divided the tasks and decided DSPC will be in the lead to obtain financing, and DSPC prepared an information memorandum and asked the bank to make a financing proposal. And to help with getting the financial, the loan from the bank, there was a subsidy involved, and they have obtained an SDE subsidy. That subsidy was already discussed in the first hour when Gino talked about negative prices and also about the subsidy. And to the right, you can see how this subsidy scheme works out in practice. So the subsidy scheme is meant to help the transition to renewable energy production and other technologies that reduce carbon dioxide emissions. And they have a guarantee of a minimum amount for the produced power in kilowatt for 15 years. And to the right, you can see that you have, as they say, a phase amount, which is the subsidy amount. And in the picture, you can see that the phase amount is 88 megawatt per megawatt hour. And on the other hand, you have a base energy price of 29 megawatt hour. And dependent on the realized market price of energy, which is presented in the orange bar, you will have an amount what's it called? The revenues consist of an amount from the purchase of energy and also a subsidy amount. So if the apex price or the market price is 35, as you can see in year number 1, and you have a subsidy amount or a phase amount of 88, the subsidy will make sure that the amount is the total amount received is 88. So you have 35 from the purchase from the off-takers, and then you have 52 to make sure that the 88 is realized. In the next year, you see that 30 is the revenue from the EPEX, and the revenue is what's it called? You have the subsidy amount filling it up until the 88. Only in year 4, you can see that since the apex, the real market value of the electricity is below the base energy price of 29, you see that you have a gap. And you see that the subsidy amount only at maximum is 65. And this means that your total price will not be 88, but it will be 65 plus 16, which is 81. So that means in that year you have a bit less than in the other years. And on the other hand, you can also have, as you see in year 11 and 12 and 13, that the real market price, which is the orange bar, is above the 88 line. And then you have an extra. So then your revenues are higher than you would have expected based on the face amount. And then the government will not have to give you any subsidies because you already received more than you were expecting. So this basically is how the subsidy scheme works. In 1 year, the subsidy amount can be really a lot, and in other years, it can be zero. It's all dependent on how the market is developing, and that can be quite, it can be very intense, as Gino showed on the slides we looked at before the break. Especially in 2022, there were these extreme swings. But it can also be that it's more moderate movement in the apex price. So this is how it goes, and the maximum subsidy, as we just now discussed, is the face amount minus the base energy price, and the market value of the energy is recorded in the correction amount, which is determined at the end of each year based on the EPEX prices during the year. But also, before a year starts, the RVO already determines a starting amount that you get upfront. So you get 80% advance per month on the expected energy production against a correction amount. And at the end of the year, you settle it for the remaining payment of that 20% based on the final realized EPEX prices. The SE subsidy is also maximized on the maximum numbers of full load hours. This is 950 hours for these solar installations for this subsidy scheme. And then we have the technical advisors, which calculate the number of hours and the total production that can be subsidized by this SDE scheme. One of the important items within the SDE is that a project has to be realized before a certain end date, because otherwise you will have to get a new SDE. The old SDE will not be valid anymore, and you run the risk that you don't get the same phase amount of 88, which is quite favorable at this time. And another item with SDE and phase amount and base energy prices is that they are not indexed over time. So they stay flat during the whole lifetime of the project, at least these 15 years that we look at. They are not indexed, so there's no correction on that account. And the transaction structure is actually in line with what we also looked at from the theoretical perspective before 10 o'clock. You have two 50% shareholders, which together have floating solar Almere BV, and that is the ring-fenced credit base, which means that, this is the credit base that you have to take into account for your financing as a bank. On the right side, you see that there is a contractor, the Floating Solar Tracking Corporation, which is also one of the shareholders, and they also do the operations and maintenance, which is not very uncommon. On the other hand, you also have advisors to the client for legal, for technical, and for insurance due diligence, and especially technical will be very important when you have these kind of new technologies which have never been banked before. And we have the municipality of Almere, who is the counterparty when we look at the right of superficies, the opstalrecht that we discussed also in the previous hour, the lease agreement with where the solar panels have to be placed. And we have Eneco, which is a well-known company in energy. And that's our off-taker with a power purchase agreement. On the other hand, we have the Rijksdienst, which provides the SDE Plus subsidies. And we have ING as the proposed senior debt provider. And next to that, you see crowdfunding. Crowdfunding can be an extra junior part of the funding of a project. So that means that the bank has the senior part of the loans, and after the bank, you have the crowdfunders that can receive their junior interest and repayment amounts after the bank has received its payments, if there is still some funds left to get the payments. If we look at a total project, you look at what are the users and what are the sources. If you look at the users, you have engineering, procurement and construction, the EPC contract. That was the Floating Solar Tracking Corporation, the EPC provider, and that makes up for 72% of the total capex. Next to that, you have the transformation station to make sure that the power can go to the grid, and you have the grid connection costs, and they are quite sizable together. And smaller parts of the budget go to civil work. Also, due diligence costs can be quite high, dependent on how much, how complicated items are. And we see that you have a 3.6% contingency budget, which is necessary to make sure that if you have some cost overruns, that you don't get into trouble immediately, but you have taken some kind of a lot of cost overruns into account, and you have some budget to not get stressed out at the moment something goes wrong. You have the development fee, which is 5%, and that is really all the efforts that the parties have already put in place before the project is at the stage that we can look at financing. So total capex 10 million. And then we look at how are we going to finance that capex. And what they already know is that they aim to provide 10% equity. And we see these other items, which is crowdfunding, and we see that as part also of the vergunningen, the permits that are given, that municipalities often say the local community needs to be involved, and they also need to be able to gain something by the project, not only the transition to renewable energy, but also get the opportunity to invest in these kind of projects. And they propose a loan with a interest rate of 6.5%. And these kind of SPVs cannot organize that by themselves, so they have this crowdfunding platform, We Share Solar, and that helps them to get this crowdfunding. But we're not sure to what extent the crowdfunding needs to take place. And if you look at the rest, then always the idea is that they want as much bank financing as possible, and to the extent the full 10 million has not been is not filled in at that time, you have to fill in the remaining funding gap by the joint venture partners through additional loans, which will also serve as junior loans, as we discussed before 10 o'clock. So the company wants to inject the required funding on a pro rata basis and pay the development fee to the 50-50 equity shareholders, DSPC and FSTC, when the transaction is closed and all conditions have been fulfilled by the borrower. And that is the moment of financial close. And if we look at the assumptions of the project, which is a solar project with a total installed capacity of 17 megawatt peak, you have the yield forecasts. These items are usually in the technical due diligence reports, and they use software where they can forecast what solar radiation will do, and it is quite predictable and shows low volatility, which helps in forecasting production for a longer period of time. And this yield study resulted in the following production levels. P50, which is graph A. If you look at the bottom of the slide, P50 is where you're exactly in the middle of this asymptote. On the one hand, you have the 50% chance that the output will be lower. On the other hand, you have a 50% chance that the output will be higher than this P15 2600 megawatt hours. And on the other hand, you have a conservative banking case because, with banking you use money which is not equity, so you don't have an upside. You have to be risk aware, and you want to use conservative inputs to make your forecast. So we say, hey, we only want to run a 10% chance that the output is lower than we expect. So here you say for the banking case, we use the P19 power output, which is 19.800. Then you have the predicted annual degradation, and this is the degradation of the solar panels. So every year we expect the solar panels to perform a bit less, so that's almost 0.5%. And we have energy production, electricity production by the off-taker Eneco for a full duration of 15 years under a power purchase agreement against a fixed price. This is what we call a corporate PPA. We have a fixed price, you don't use the market price. And for the model's sake, we say, well, the actual revenues are the production times the market value, and that for that you can use this fixed price. And then the SDE revenues, the subsidy revenues, you can calculate as the difference between the face amount and the electricity price as you get against this power purchase agreement. Then we have the operational costs. And if you have any questions, please drop in. And they consist of operations and maintenance, asset management, insurance, real estate tax, and fees for the right of superficies and electricity transportation costs. And we assume that these are fixed, but they are indexed with 2.5% inflation indexed per year. And we also have depreciation of the assets, straight line over a period of 20 years. And to add to the complication, we also have income tax, a lower bracket, and we have a higher bracket, 90%, 25.8%. And now we want you to look at the investment decision. We are now still at the beginning of 2022, so we are 3 years back in time, and CAPEX will be spent during that year. completion of the project occurs at the end of 2022 and the operations start the 1st of January 2023. And after 15 years, the 15 operational years, the joint venture will sell the assets to a new owner, and we have a sale price at the end of these 15 years equal to 3.1 million euros. So these are all the assumptions that you need to take into account to make sure you make the right investment decision. And to help you a bit, we have a small model to make sure you can in the right way look at how this works out when you look at revenues, costs, and cash flows. We have an equity case, the P50 case we discussed earlier, and we have a banking case where you look at the case and you have these bank financing as well. Just maybe starting with the equity case, you have this power production, you have this, you start with the PPE price, and you have the SDE plus to make sure that your total of face amount of 88 is you get to that 88. And here you can see that you do you get to the revenues by doing P times Q, and that these are the costs in year one. Then we get to an EBITDA, an EBIT, taxes, and net earnings. And this is the unlevered free cash flow. And when you go to the banking case, you get some extra items, which are the CFATs, as Gino explained before 10 o'clock, which is the EBITDA plus the taxes. And then we have the installments and the interest on senior debt and the senior debt servicing, leading to a DSCR. We have the following assumptions and definitions for your case. I think this is probably something you want to look at with your group. Because these are the input variables. We have a funding of 65% senior debt. We have 15% crowdfunding, 20% equity. We have assumptions regarding repayment profiles, linear and in 15 years. And we have these interest rates for senior debt and crowdfunding. Of course, the senior debt.
Unknown participant is now exiting.
Oh. I don't know why I get this one, but and the required return for equity is 11%. So obviously, as I said, the bank financing is the lowest interest because it should be the lowest risk as well. The bank will always be paid first. Afterwards, you have the crowdfunding, and if there's still some funds left, then the equity, the shareholders will get their return on equity. The cash flow available for debt service, you have the senior debt servicing, the repayments of the loan and the interest payments, and you have the DSCR, which is also explained before in the slide deck, which consists of the cash flow available for debt service divided by the senior debt servicing. And I think I will now give the word to Oliver because you wanted to step in on slide 36.
Right. So for the assignment, you will have to build a model, but in addition, there's also a number of open questions that you'll need to answer. And so based on your model, you will come to a conclusion. For example, for the equity case, you can then look at the NPV of the project and say, well, is this a good idea? Should we do this investment from the perspective of the joint venture? Another perspective then for question 2 would be the bank's perspective. So clearly that's based on the bank case. And here you have to decide, okay, should ING Bank finance this investment? Is it a good idea? And then you look at things like probably the debt service coverage ratio. You need to determine, is that high enough to be, for ING to be comfortable to finance? Actually that's question 3 that I just discussed. Question 2 is once again from the perspective of the joint venture, but now looking at the projections as it is in the bank case. So the more pessimistic projections about the production levels, but also the benefits of the debt financing in terms of driving up your rate of return due to leverage. Then the 4th question is about the DSCR. We want you to provide a bit more detail about, whether that's high enough of a number and what stress cases could actually impact the minimum that you require that ratio to be at. And then the last question will be about this topic that Gino discussed about the negative electricity prices and how that can be alleviated or how this can be addressed. So we don't want to give too many pointers here, but I think in the prior discussion already you should have picked up some potential solutions to this problem. And then we just want you to briefly mention those potential solutions and then also how those would be implemented in your model, in your Excel model. Right, could you move to the next slide?
Yeah, and maybe also good to say that all the items we discussed on the SDE with negative prices, here we take a bit more simplified approach. So we don't take into account that SDE will not be paid at negative prices. So you don't have to match the graph from the earlier on in the slide deck with this. Otherwise,
yeah. So in the business case, we assume that you get this purchasing power agreement, and then you have a fixed price, and then you don't need to worry about negative energy prices. But just hypothetically, if you didn't have that purchase agreement, then you would be subject to the negative energy prices. Then how would you deal with it? Great point. Yeah. Then some technicalities, some logistics of the assignment. So it's due by the 28th of May at midnight, basically. What you have to do is you have to build a financial model in Excel, and you have to use Microsoft Excel. Please don't use Google Sheets or other software because that always leads to problems. Stick to Microsoft Excel. And then what we do is we provide you with a model template. So basically we made a solutions model, but then we deleted all of the numbers in it. So all that you get is the structure of the model. And now you have to start filling in the assumptions from the business case. Then you have to build up the tables based on those assumptions, calculate NPV, calculate DSCR. So we're already helping you by providing you with the structure. And then all you have to do, which is still quite a bit, is you have to fill in the values. You have to then calculate the outcomes, and based on that draw conclusions in the open questions. Also, these slides will be posted on Brightspace, so don't worry about missing any of the points here. You can definitely read up on it later on. Also, there will be a classroom model on Brightspace, which is a very simplified Excel model that is just there to show you how you should connect cells. Because for many of you, it might be the first time that you're actually building up an Excel model. And then it's important to know how do I connect cells with functions, and how do I avoid hard coding, and that you can see in this very simplified classroom model. All right, yeah. Then a little bit of a complication, which is that the book Burke and DeMaso, as they discuss project finance, they really emphasize the importance of using this adjusted present value method when you calculate the NPV of a levered project. So in the bank case, it's no longer just equity financing. Instead, it's a mix of equity and debt financing. But as you pay off the debt over time, that also means that your debt equity ratio is going to change over time. It's going to decrease. And as we will learn actually in 2 weeks, when you calculate the cost of capital of an investment project, you make the assumption that the debt equity ratio is constant. That's the standard approach that the book takes. And only then in chapter 18 of the book do they say, okay, what if actually the debt equity ratio would change over time? Well, then your normal approach no longer works reliably. And then you want to use something called the adjusted present value method. And for that, you basically take the unlevered NPV, which is the NPV of the investment project if it is equity financed, and then you add on top of that the present value of the interest tax shields. So if you pay interest that is tax deductible, and the savings in taxes, those are the interest tax shields. You calculate the present value of that, and in a nutshell, that is going to be the value of the debt financing to you as a firm. Because the value of debt in financing a project is that you have this deductibility of the interest expenses, and that's going to add on top of the NPV that you could generate if it was all equity financed. We will talk about this in the tutorial this week, so don't worry, we'll cover this in more detail. And also the model template already helps you to go step by step in calculating the levered NPV, the NPV of the project that does have leverage, i.e. debt financing. Right, yeah, I think that about covers it.
Okay, then we'll go to the next item, because we ended the really content part of the presentation at this moment. We have not seen any questions in the chat yet, so if you want to, if you have any questions or maybe